Let me tell you a story about the greatest investor of all time. Warren Buffett bought his first stock when he was just 11 years old. And do you know what he thought? He thought he had started late. Even as a boy, he devoured every book on investing he could find. He tried stock charts, market timing, all the little tricks that everyone else was using. It was exciting, but unprofitable. At 19, he discovered a book that would change his life forever. The Intelligent Investor by Benjamin Graham. And in that book, he found 3 timeless principles. They were simple, they were clear, and they became the foundation of his entire investment philosophy. The same philosophy that turned him into a billionaire and one of the most respected minds in finance. Today, I want to share these 3 rules with you, because if you understand them, if you live by them, you will never look at investing the same way again. Rule 1. A stock is a piece of a business. When most people look at the stock market, they see numbers on a screen. Ticker symbols, green arrows, red arrows. They see prices, but they do not see businesses. When Warren was young, he memorized every ticker symbol on the exchange, but he had no idea what those companies actually did. It was only when he read Graham's book that he finally understood when you buy a stock, you are buying part of a business. That is timeless wisdom. If you owned a bakery in your hometown, would you check its price every 5 minutes? Would you sell it just because someone said, "I think your bakery is worth less today"? Of course not. You would judge your bakery based on the quality of the bread, the loyalty of your customers, and its ability to make a steady profit. Investing works the same way. Do not think of stocks as lottery tickets. Do not gamble on symbols you do not understand. When you invest, ask yourself, what business am I truly buying into? Does it have strong products and loyal customers? Is it managed by honest, capable leaders? Can it thrive for the next 10, 20, even 50 years? And remember this: it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Invest like an owner. Study businesses. Value them as if you had to run them yourself. That is rule number 1. Rule 2. Let the market serve you, not instruct you. The second timeless rule comes from Benjamin Graham's concept of Mr. Market. Imagine you have a business partner named Mr. Market. Every day, he comes to you and says, "Here's the price I'll pay you for your share of our business, or the price at which I'll sell you more." Some days, he is wildly optimistic. He offers you an absurdly high price. Other days, he is deeply pessimistic, practically giving it away. Now here's the key. You are never required to do business with Mr. Market. You can ignore him entirely until his offer makes sense. But what do most investors do? When stocks go up, they get excited and buy more. When stocks go down, they panic and sell. They let the market instruct them instead of serve them. Warren Buffett learned early on, the market is there to serve you, not instruct you. Stocks are like a store with changing prices every day. If you see a great company on sale, you buy. If it's overpriced, you wait. You do not have to act every day. You do not need to trade constantly. You simply wait for the right opportunity. When fear drives prices down, or when Mr. Market is drunk with panic, that is when fortunes are made. As Graham said, in the short run, the market is a voting machine. In the long run, it is a weighing machine. Do not be swayed by daily votes. Focus on the true weight and value of the business beneath. Rule 3. Always demand a margin of safety. The third rule is perhaps the most important. Always leave a margin of safety if you are crossing a bridge. With a 10,000 pound weight limit and your truck weighed 998 pounds, would you cross? Of course not. You would find another bridge. In investing, we do the same thing. No matter how promising a company seems, no matter how confident you feel in your analysis, there are always unknowns. So you only invest when the price is well below the true value of the business. This margin of safety protects you from errors, from unexpected events, and from the ups and downs of Mr. Market. It allows you to be patient. It allows you to wait for the fat pitch, the kind of investment that almost shouts at you. So obvious, so safe, that you can swing hard without fear of missing. Buffett often says, rule number 1, never lose money. Rule number 2, never forget rule number 1. And the margin of safety is how you follow those rules. So there you have it. The 3 timeless rules of investment. Rule number 1, think like a business owner. Every stock is part of a real business. Buy businesses you understand, with strong economics and great management. Rule number 2, let the market serve you, not instruct you. Ignore daily noise. Wait for opportunity. Be greedy when others are fearful, and fearful when others are greedy. Rule number 3, always demand a margin of safety. Only invest when the price is well below the true value. Protect yourself from the unknown. These principles are simple, but powerful. Buffett built his fortune on them. Benjamin Graham taught them decades ago. And Jim Rohn reminded us, success is neither magical nor mysterious. Success is the natural consequence of consistently applying the fundamentals. Investing is not about predictions. It is not about timing the market. It is not about following the crowd. It is about patience, discipline, and wisdom. If you can understand these rules and live by them, you may not become the next Warren Buffett, but you will avoid the big mistakes. You will build steady wealth, and you will create a future of independence, security, and lasting freedom. Because when it comes to investing, timeless wisdom always outperforms temporary trends.